This is Super Investors in the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This podcast is brought to you by the Felder Report. When I'm not interviewing one of the most interesting minds in the world of finance, I'm doing a ton of reading and research. I put together some of the best things I find each week into a free Saturday morning email. If you're interested in getting it, just go to thefelderreport.com, click Join Now right there on the homepage, and you'll be good to go. My guest for this episode is Joseph Wang. Joseph is one of the most knowledgeable people I've come across when it comes to the world of central banking and how it intersects with markets. His experience on the open markets desk at the New York Fed gives him unique insight into the inner workings of the financial system and how it has evolved in recent years. In this episode, we discuss the shift in both monetary and fiscal policy over the past decade and how it has crucial implications for investors in coming years. So without further ado, please enjoy my conversation with Joseph Wang.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Joseph Wang, welcome to the show.
Thanks so much for having me. It's a pleasure to be here.
Well, you're somebody that I can't remember when I first ran across your work, but since I started reading, your Twitter feed and your blog, it's been really helpful for me in understanding a lot of the dynamics in terms of monetary policy, how the interplay between markets and monetary policy and those types of things. So I thought, this would just be a great chance to introduce you and your work to my audience. In your bio on your website, it says you actually in a previous life practiced law. What sort of law did you practice, and how did you end up making the transition to the world of finance?
Yeah, I used to be a lawyer. I don't like to mention that too much because, I want people to like me. But so I when I was in college, I wasn't super sure what I wanted to do. I just knew that I wanted something that was fancy and that made good money. I think that's pretty common if you're a young man. And to my 20-year-old mind, that was being a lawyer. That seemed really nice. You get to be in a fancy office, you get to make good money. And so I went to law school at Columbia, and afterwards I went into the practice of law at a law firm. And then I realized that you definitely do get a really nice office, great views. You definitely do, get a good salary. But at the end of the day, the problem is you actually have to practice law. Now, practicing law, in case you guys are not aware of, it's basically writing term papers for the rest of your life. So you're going to have to be spending, let's say, 10 hours a day in the office, just making sure you don't have any extra commas, just reading really, really, really boring stuff. And that's not really what I wanted to do with my life. I graduated in 2008, so that was right when Lehman went down. And what I realized then is that, all the stuff happening in global macro and finance is just so much more interesting than what I'm doing chasing commas. So I wanted to work in something that had to do with macro. And I was really interested with, let's say, how stuff like quantitative easing worked, what drove market prices, and so forth. So eventually, I wanted to make that transition into something that was more markets oriented. But being in the aftermath of the great financial crises and being a lawyer, that just wasn't a really good time to make that transition. So in order to do that, I had to go back to school. So I went back and I got a degree in financial economics. Afterwards, I worked at a ratings agency as a credit analyst, studying securitized products. And eventually, I made myself towards a more market-facing role as a trader on the Fed's trading desk. And that's where I began to learn a lot more about the financial system, about the Fed, and about what drives asset prices. And that's kind of what I teach and what I read about right now.
Yeah. Well, the open markets desk, how did you find that job? What drew you to that job specifically?
So, I actually, honestly, it wasn't really my first choice job. I wanted to be at a big bank, that seemed to be where the excitement and the money is. But sitting at a rating agency, you learn a lot, but the way this works is that you kind of want to be closer to the action. And if you work as a ratings analyst, your clients are on the investment banks, and so you aspire to be either at an investment bank or on the buy side at an investment fund. I was there when I was there. Things were slowing down. I was looking for new opportunities. I feel like I had learned all there was to learn. So I applied everywhere. And at the end of the day, for whatever reason, the people at the New York Fed, the trading desk there, gave me an offer. I think they were looking for someone who was interested in the subject and who had good quantitative skills. And so I spent a lot of my time building models and writing code and stuff like that, and they needed someone like that. So they gave me an offer, and I went. And at first, it was kind of surprising. So I was hired into the money markets desk of the New York Fed. So for those of you who don't know what money markets are, I didn't know what money markets were either.
Yeah.
So I just assumed that they were really, really boring things that you would go and put your money if you were really risk averse. But there's actually a lot to it, because at the very foundation, studying money markets is studying the building blocks of plumbing of the financial system. And that's not something that people do a lot, but it's also something that I think adds tremendous value. So I found the whole situation to be really exciting, because I was able to really get into the nuts and bolts in a way that a few people are. Because if you're at the Fed on the trading desk there, you have access to tremendous amounts of confidential data, and you also have access to a lot of relationships. So you're kind of like the eyes and ears of the FOMC. So you have relationships with basically all the major banks and all the major investment funds, foreign central banks, and so forth. So if you ever want to know something about the market, you call them up and you can have a candid conversation. And when you're there for a few years, you really, I think, build up a good view of just what's going on in the world and how it all works.
Yeah, and so you had kind of a front row seat to maybe the most important station within the money markets. I guess how does the open markets desk work? What is its purpose? What is its main function?
Yeah, great question. So the Fed, like any other financial organization or any other bank, I guess, has a trading desk. It's located in New York. That's called the Open Markets Desk. And its primary responsibilities are two. First, it's to implement monetary policy. So you hear about the Fed doing quantitative easing. You hear about the Fed doing FX swap lines with foreign central banks. You hear about the Fed doing, let's say, borrowing in the repo market or lending in the repo market. That's all done by the Open Markets Desk. So they do the trade on behalf of the Fed. The second thing they do is to brief the FOMC about developments in financial markets. So let's say that something goes down in markets. How do people sitting in Washington know what happens? How do they get their information? Well, it's the desk's job to provide that for them. So when you're on the Open Markets Desk, every day we have 2 calls with Washington to brief them on developments in the markets. Like I mentioned before, the way that we go about figuring out what to brief them on is just through the big network of contacts the Open Markets Desk has, as well as a lot of the data that the desk has. So it's kind of like a very large intelligence gathering apparatus. Actually, I'm pretty sure it's probably the best, simply because you have such a wide amount of relationships, and everyone understands that when the Fed calls, everything you tell them is confidential. So they are more willing to be candid with you. So that's kind of the 2 main jobs the desk does.
Interesting. So, the reason I've wanted to talk to you about a lot of these things is I started out my career in finance as kind of a diehard value investor, but it didn't take me long to realize that macro and monetary policy play such a huge role in the markets in this day and age that I have to start paying closer attention to a lot of these things, right? I was a head trader at a hedge fund through the dot-com mania and bust, and then went through, obviously the housing bubble and the great financial crisis. And you realize that a lot of these things are, if not necessarily driven, by monetary policy as a primary driver, it at least exacerbates the cycle in ways that you have to pay close attention to. So, I'm curious to basically just understand your thoughts. I guess maybe help me understand from your perspective the trends in monetary and fiscal policy over the last 15 years since the financial crisis. I guess let's look at in the wake of the crisis. The Fed began a new program of quantitative easing and specifically targeting asset prices. Can you, I guess, just help people understand what is quantitative easing and how it marks a kind of a departure from monetary policy that preceded it?
Sure. And Jesse, I think you make a really good point that it seems like over the past decade, at least, asset prices are mostly driven by these macro events. If you go back to, let's say, the 80s or something like that, value investing was very much in vogue and it worked really well. You have all these papers, say, by Fama French talking about it. But it seems like the markets, as they do, usually change over time. So over the past few years, that's been less effective. Now, over the past 10 years, I think the biggest drivers of asset prices have been official sector actions, like you mentioned, fiscal and monetary policy. And that really began, I think, from my perspective, really began to be increasingly important since the great financial crisis with the onset of what people commonly call quantitative easing. Now, quantitative easing, when it was rolled out, was terribly, terribly misunderstood. But at the end of the day, it did work exactly as intended. So back then, interest rates were at zero, and the Fed wanted to provide additional monetary accommodation to the economy to help it recover. Now, from the perspective of a central bank, their tools are interest rates. Now, the Fed primarily acted by raising or lowering the short-term interest rates. That's a problem when rates are already at zero. So if rates are already at zero, how are you going to provide additional accommodation to the economy? Well, you try to push down longer-term rates. Now, how do you push down longer-dated rates? You just go and buy a whole lot of treasuries, of course. After all, if you go and buy a few $1 trillion worth of treasuries, the price of treasuries goes up, the yield goes down. And from a central bank's perspective, you're lowering interest rates and stimulating the economy. Now, I think the big misunderstanding back then was that, just how does this actually work? Now, the Fed is printing a whole bunch of money, right? So obviously, tremendously inflationary. We got to go and buy gold, look at shadow stats that's showing out of control inflation and so forth. And that all turned out to be wrong because they misunderstood some of the mechanics of the financial system. So the Fed printed a whole bunch of money, totally true, but then they used that money to go and buy treasury securities. So if you're thinking it from an investor perspective, let's say I had $1 million worth of bonds. I sold them. Fed bought them with newly printed money. At the end of the day, I don't have $1 million worth of bonds. I have $1 million worth of deposits at a bank. So at the end of the day, I don't actually have more purchasing power. My wealth really isn't changed. Instead of having $1 million worth of bonds, I have $1 million worth of cash. And that's what the Fed did at a grand scale. Just create cash, but use it to buy bonds, which are also, money-like assets. And what that did was exactly as what the Fed intended. It all things equal, pushed bond prices up and interest rates down. It did not lead to runaway inflation, but it was very successful in inflating asset prices, which, as Ben Bernanke noted, was the exact purpose of quantitative easing. Keeping interest rates low does many things, but among which include raising the value of financial assets and creating a wealth effect. So the Fed can't actually give people money directly, but it can influence asset prices like equities, like house prices higher, and that makes people feel wealthier and actually have more wealth that they can spend. For example, if you were holding a bunch of S&P 500 stock index back then, and quantitative easing pushed those asset prices higher, maybe you would take some of those gains and spend them on goods and services, and that could stimulate the economy. looking back, it's hard to say that it had a big impact on the real economy. So maybe that wealth effect was not super effective, but the actual portfolio rebalancing impact that inflated asset prices turned out to be really effective. And I think that's been a big part of the Fed's toolkit since that era. So going forward, for example, let's say the past 2 years, when we had high inflation, one of the ways that the Fed would try to get inflation under control is to have a negative wealth effect, whereby people would have, less amounts. The dollar signs in their brokerage accounts would become smaller, and maybe they would not go and buy as many Ferraris and Rolexes as they were, say, during the crypto boom.
Right.
So, if you're noticing that asset prices tend to be more driven by Fed policy, I think it's because Fed policy takes asset prices into account more so since the financial crisis than they did in the past.
Right. And I would just add to what you mentioned that when the Fed was buying treasuries and leaving the sellers of those treasuries with cash in a bank account, that was zero yielding cash, and so they had a huge incentive to move that into something else that was hopefully generating return above zero. So I created as my friend John Hussman points out, kind of a hot potato effect where nobody wanted to be left with zero yielding securities, and so it kind of created a demand for risk assets and people going out the risk. Part of what forced, I think, QE to go on even longer than probably Bernanke intended early on was the fact that fiscal policy was so meager at the time. Right, we had the Tea Party, and fiscal really wasn't stepping up to kind of help the economic recovery in the wake of the crisis, and so the Fed potentially felt like they had to do more to help the economy than they otherwise would have. Fiscal policy has also changed dramatically in the last 10 or 15 years, right?
It's changed tremendously. The fiscal policy we have today would be unrecognizable to people a generation ago. In the 90s, we actually had a fiscal surplus. And at that time, the discussion was, gosh, guys, we have a fiscal surplus. Let's go and buy back some higher yielding treasury securities and save the taxpayers some money. Now, that seems so, seems so quaint today, when what we're having is, based on official sector projections, a government deficit of about $1.5 to $2 trillion every year, basically forever. So we've really changed as a country in our attitudes towards fiscal policy. A generation ago, people wanted to have a balanced budget. That was part of what they thought was a good thing to have. But today, though, I think nobody really cares about that. And that has a tremendous impact on both the real economy and financial assets. Now, going back to the example of quantitative easing, as you rightly note, when someone has bank deposits rather than treasuries, bank deposits yield zero, and they also have credit risk. So what happens is that if you are an investor who can't take bank credit risk, or who have some desire for some yield, you go and you move up the risk spectrum. Maybe you buy Apple bonds, maybe you buy agency mortgage-backed securities, maybe you buy equities, and so forth. Now, fiscal policy is altogether different in that it actually, when you deficit spend, it actually creates purchasing power. So going back to the example that we just discussed, if the U.S. Treasury, let's say, deficit spends by $1 billion, it's issuing $1 billion of treasuries. It's creating that out of thin air. And if I were to give you a treasury security, you would go from having, let's say, $0 in your brokerage account to $1 million in your brokerage account. So that actually adds to the overall purchasing power of the economy. So one way you can think about this is that, so let's say that I have $1 million in cash. I go out and I buy newly issued treasuries. So from my perspective, of course, instead of having cash, I have treasuries. Okay, so my purchasing power is unchanged. But then Treasury then takes that $1 million and spends it back into the economy. So someone somewhere has that $1 million I originally had. So at the end of the day, the amount of bank deposits in the banking system doesn't change, but you have an extra treasury security. So the overall stock of wealth, the overall purchasing power, the overall set of financial assets actually increases with deficit spending. So in a sense, I think of it as money printing, much more so than I do of quantitative easing. So when you have a treasury that is basically deficit spending to the degree that it's doing right now, I think it's inflationary. And I think it's the primary reason why we have persistent inflation today. It's because of the tremendous deficit spending we did in 2020 and 2021. And if you see the trajectory of what's happening, then you could easily have the view, which is what I have, that we're going to have a decade of persistently high inflation.
Well, I really appreciate this point that you're making, because so many people did think that when quantitative easing was first initiated by the Fed, that it was going to create inflation. But obviously that didn't happen. But potentially what QE did was it enabled fiscal policy to be inflationary by keeping interest rates too low. It used to be that politicians were afraid of, if we got too crazy with spending, the bond vigilantes would kind of put us back in our place, right? And interest rates would bond market would send a clear signal that you're spending too much. But that signal, that channel through the Fed's intervention in the Treasury market has essentially been removed. And so potentially, do you think that the growing quantitative easing programs over the last 10 years really encouraged this increasingly profligate fiscal trend that we're seeing?
I think that makes sense. I mean, so obviously the Fed holds a few $1 trillion worth of treasuries. It puts downward pressure on interest rates, right? So if you're Congress and you have people complaining about your fiscal spending, you could easily just point to treasury yields and say, I don't see a crisis. I'm sure that we can keep on spending. So I think that's part of it. But I think but I think if you take a step back, though, I don't actually think, even if we did have higher interest rates, Congress would care either. It doesn't seem like anyone ever mentions that. I'm worried about the congressional budget deficits and so forth. So I think even if interest rates were higher because the Fed were buying less, I don't know if Congress would care. It just doesn't seem like it's part of their concerns right now. With respect to the bond vigilantes, I think that reflects a change in the participants in the financial markets. So going back to our value investment discussion just a while earlier, I think a few decades ago, you can make the assumption that there is a large class of investors that, they're looking at earnings per share, they're looking at revenue growth and so forth. They're trying to value a company based on these metrics. And so when the company doesn't perform as well, they would punish them. But fast forward today, we have a lot of investors, let's say passive investment vehicles and so forth, who don't care as much about this. And so because the underlying market participants have changed, that whole framework of looking at equity markets through a value investment framework is not as effective today as it was in the past. Now, using that keeping that in mind, let's look at bonds as an asset class. Now, we want to think that there are class of investors who are looking at bonds through the lens of, say, growth, inflation, and stuff like that, and looking at the fiscal deficits of a country. And so if the country spends too much money, the bond vigilantes would show up and they would punish that country because there's a big class of investors who view the world in that framework. Now, that may have been true a few decades ago, but I'm not sure that's true today, because when I look at who's participating in the treasury market, obviously we have the Fed, who doesn't care about, what Congress does. We have commercial banks who, they're kind of strongly encouraged by regulation to buy a lot of treasury securities, right? So they're not really looking at growth, inflation, or deficit. They're thinking about, these regulations say that I have to buy this, so I'll buy more of this. Or you can look at another big buyer are foreign central banks. Now, foreign central banks, they have a whole bunch of dollars that they have to manage. They have a very strict mandate saying that they can only take, sovereign credit risk. So regardless of their personal view of the sustainability of the federal fiscal deficit or growth and inflation, all that stuff, well, their mandate says, I have dollars, and if you have dollars, you buy treasuries. And so I do that. So
Right.
the underlying structure of the market, I don't think they're as sensitive to things like the fiscal behavior of the U.S. So I think that's another reason why that we actually haven't seen a big bond vigilante revolt at the moment.
That's a really good point. I think it was several years ago I read a good piece from GMO where they pointed out that one of these other trends that's gone along with this 15-year trend in monetary and fiscal policy is the trend in price-insensitive buying, whether it's passive investing or central banks. But really, the Fed, quantitative easing is the primary form of price-insensitive buying that's out there, and it potentially encourages price-insensitive buying on the part of passive investors in other areas, because they're sending a signal that it doesn't necessarily pay to pay attention to value and these things. But I want to come back to you mentioned that the way you're thinking about fiscal policy. I think you said that you see it as monetary policy in relation to fiscal is monetization. Is that correct?
I think of it as changing the composition of liquid assets in the financial system. So fewer
let me just.
Yeah,
I was just going to ask you. Let me. There's a quote from Ben Bernanke I'm thinking about specifically. I think it was from actually February 2011. He was testifying in front of Congress, and he said he was asked by a congressman, "How is this not monetizing debt? This is right in the wake of QE2?" He said, "How is this not monetizing the debt?" And Bernanke answered, quote, "Monetization would require a permanent increase in the monetary supply to pay the government bills through money creation. What we're doing here is a temporary measure, which will be reversed, so that at the end of this process, the money supply will be normalized, the Fed's balance sheet will be normalized, and there will be no permanent increase either in money outstanding or in the Fed's balance sheet." That was more than a decade ago. And I think the Fed's balance sheet was at about $2.5 trillion at the time. Obviously, it's a lot bigger than that today. And so I look at that and I go, by Bernanke's own definition, then this has been monetization of the debt. Would you agree?
Yeah, it definitely is monetization of the debt. I mean, so like I believe it was Reagan who mentioned, the closest thing to eternal life is a government program, right? So the reverse repo facility was also thought of being temporary, but it's still here. So, okay, it is monetization, but like I mentioned earlier, if you look at it from an investor perspective, you're just kind of changing the composition of the liquid assets in the financial system. So that's where the impact on pricing and the impact on the real economy could come from. But the Fed is kind of full of contradictions here. For example, we just recently had a debt ceiling episode, right? And one of the ways the debt ceiling could be resolved is that if the government just had a big overdraft in their account at the Fed. So instead of issuing treasuries to fund their payments, they would just incur a large overdraft. But the government will never do that because it would violate the idea of the Fed lending directly to the government. But as you mentioned, the Fed is already buying, has already in the past bought trillions of treasury securities. So they're in effect already lending to the government. I think they would get around that this technicality by saying that the Fed doesn't buy treasuries directly from the government. Instead, it's buying them from the private sector. So
Right.
Treasury issues debt, someone in the private sector buys that debt, and then Fed buys the treasury securities from that private investor. Now, come on, that's not, you can't seriously say that. That's a big difference, right?
Right.
So I think it's just a wink and a nod. Yes, I totally agree with you. When the Fed is buying treasury debt, they are essentially funding the U.S. government. But that doesn't necessarily, that's separate from having the financial and macro impacts. But on a legal sense, I think that distinction between whether or not the Fed is actually monetizing treasuries is silly. Of course they are.
Yeah. Well, there was an interesting interview with you, Barron's, back in September, and I'm just going to quote you from this because I think it kind of points to your confidence in the ability of the Fed to normalize the balance sheet at some point in the future. Quote: "We are locked in a world where there will always be QE because the Fed will have to ultimately become the buyer again. The growth in Treasury issuance is faster than the market can handle by itself." To me, that sounds like you see the balance sheet as being just kind of on a trajectory that's not going to change. I mean, right now they're trying to reduce the balance sheet, but at some point they're going to have to reverse course. Is that correct?
So that's my belief. So if you look at the projected issuance of Treasury securities, it's very obviously unsustainable. So today we have about 25 trillion of marketable treasuries outstanding, and it's going to grow by $1 to $2 trillion a year every year forever, based on current projections. I suspect those projections are underestimations because they're based on the law that's on the books today. And as we've seen over the past years, there's always new legislation that adds to that deficit. So you can't just keep issuing debt forever. At the end of the day, someone has to buy it at some price. I suspect that you will eventually get to a point where you could have some accidents happen in the treasury market, similar to what we saw in the UK gilt market last year. So in the UK gilt market, we saw long-dated gilts basically spike higher simply because the market reached a point where there was a lot of selling and there just wasn't a lot of buying. In order for you to be able to continue to issue as much as you want, you have to have the underlying plumbing in place. By plumbing, I mean, let's say the underlying liquidity in the treasury market. Just as a rough example. So today, on average, there's about $600 billion in cash treasuries traded. 20 years ago, there was about $400 billion in cash treasuries traded on an average day. So we went from $400 billion a day to $600 billion a day. Okay. 20 years ago, we had about, let's say, $6-7 trillion of treasuries outstanding. Fast forward to today, we're closer to 24, 25. So over the past 20 years, the amount of treasuries outstanding has grown by 3x, but the underlying liquidity of the market has only grown by 50%. So the growth in issuance, so the underlying market liquidity doesn't scale with the growth in issuance. And so as long as that's the case, eventually you could come to a point where you hit some kind of air pocket and you have these, suddenly the market goes without bid, as it did back in the UK gilt market incident. So I think that's definitely some significant risk, but also there's a very easy way to solve it, and that is to have the Fed go in and have a big presence in the markets. One way they could do this is to have some form of soft yield curve control, like they do at the Bank of Japan. Just hypothetically, I mean, let's say that I just keep issuing treasury securities, trillions and trillions and trillions. There's going to be a point where the price becomes so high, that is, the yield becomes the price becomes so low, the yield becomes so high that's going to interfere with monetary policy and the functioning of the economy. So should that ever arise, then you can have the Fed step in, either do targeted purchases like the Bank of England did, or maybe just some kind of soft yield curve control where they say 10-year yields cannot exceed this amount of level. I say this because, like I mentioned before, the issuance of treasuries is not on a sustainable trajectory.
That reminds me of a quote. I think it was Bill Dudley actually wrote a piece for Bloomberg earlier this year, back in January. former head of the New York Fed. He wrote, quote, "While it's hard to know precisely when the persistent red ink will be viewed as big enough to matter, a fiscal crunch and bond market turbulence seem inevitable at some point," end quote. When the former head of the New York Fed says bond market turbulence seems inevitable, I'm just, I'm struck that, I guess, why do you think the market seems so sanguine about this trajectory?
I think there's two reasons. One of them is that, as we discussed earlier, just the underlying structure, the market participants, a lot of them are just not really, they're just participating because they have to, be it commercial banks or foreign central banks or the Fed and so forth. There's a lot of people who are basically inelastic buyers, so they don't care about economic conditions or anything. And another point is that I think that a lot of the people today, they grew up in a world where, rates always go lower, inflation always trends lower, government is going to get its act under control and so forth. And it's that confidence that inertia they have from a few years, a few decades actually of low inflation, that's shaping their perspective. Now, even today, for example, as I understand, the real money investor community is positioned heavily towards duration. So they're buying bonds, probably anticipating some kind of recession or return to low inflation and so forth. My sense is that these institutions, they tend to be heavily based, they build their viewpoints heavily towards their own experiences in the past. So, and for the most part, that works really well because the world doesn't change a lot very often. So thinking that the future looks like the past is usually a really good bet. Unless, of course, you're at a turning point where you could have potential regime changes. And then these more conservative ways of managing money become ineffective. I think that we're at one of these turning points.
I guess expand on that turning point where you think monetary policies, I guess just expand on that a little bit.
Yeah. So again, if you are someone who grew up over the past few decades, you saw rates continue to go low, you saw low growth, low inflation. So you think that that's how the world is. And so if you have that kind of mean reverting view, then you look at these past 2 years as just an aberration. And so, of course, you long bonds and you don't worry about any kind of disruption in the bond market. But I think there are two things that are changing. Well, actually, three things that are changing that, in my view, signal a regime change such that it's not mean reversion. It's a trend change. So the first thing, of course, is that we've talked about earlier, that there's a fundamental change in the U.S. fiscal culture. So there's nobody thinking that balanced budget is good. We should just keep spending more and more money, and we will pay for it by issuing treasuries. A good example of this is what happened with the debt ceiling, where it seems like the Republican Party, who's usually the party that cares about fiscal deficits, they kind of just caved without any meaningful spending cuts. So, everyone in Congress kind of runs on giving people free money. That could be ordinary people. Let's say we give them more child tax care or stimmies or something like that, or it could be giving money to corporations, be it tax breaks or government contracts. So I don't think it's in any politician's interest to ever cut the deficit, simply because how they win is by promising to give their constituents more money. So that's the cultural change. That means that we're going to have significant fiscal spending and, in my view, higher inflation for the coming years. The second view is that there's a fundamental change in the supply side of the equation. So deficit spending, printing money to spend, printing treasuries to buy stuff, that's the demand side. The supply side matters as well. And the supply side, it's very clear that we're heading into a world where we have fewer working-aged adults. So over the past few hundred years, our working-age population has always grown. Since the 1980s, though, we've had smaller families. And when that happens, inevitably, our population shrinks. We're getting to the point, not necessarily in the US, but more so in, let's say, Western Europe or in East Asia, where because of the low population growth, the working age population is shrinking. So, if you have fewer people entering the workforce, obviously you're going to have trouble producing the same amount of goods and services. The supply of goods and services, it looks like it's going to decline. Now, it's possible that we can make it up with technological advances in things like productivity, but actually the productivity numbers over the past year have shown that productivity has been declining. And the last thing I think that has changed is also on the supply side, and that is that we are in a world that seems to be more geopolitically unstable. The West is not happy with what's happening in Eastern Europe, and it seems like the U.S. is not happy with China, and that's kind of a problem because the West imports a lot of stuff from China and from Eastern Europe. Now, if you have more political tensions there, you're going to import, either they're not going to sell as much to you, or you're not going to want to import as much stuff from them, and that reduces the supply of goods and services as well. So you combine with demand from fiscal spending with reduced supply from demographics and geopolitics, I think you get a regime change in how growth and inflation will work in the coming years. Higher inflation, as I mentioned, but also slower growth. And I think that's okay too. I mean, obviously, we always focus on growth on an aggregate scale, but we should also look at growth on a per capita basis. If we have slower growth because we have fewer people, that's not necessarily a bad thing. I mean, if we don't have as many people, we don't really need as much stuff.
Yeah, and I really appreciate you kind of laying that out the way you did. This is something that might be the most important thing for investors to pay attention to right now, is that this period of the last 15 years, we're seeing a sea change in these areas, in fiscal policy, in demographics, and deglobalization. And people like Paul Singer and Stan Druckenmiller, Ray Dalio, and Bridgewater have warned that we're entering a new era for the economy, for asset prices, these types of things. I guess I'm curious as to what it will be that will wake up these price insensitive buyers of assets to realizing that strategy is not necessarily the best way to move forward.
Totally agree.
So I guess we had you actually wrote about the basis trade recently, back in 2019. Actually, the last time the Fed really tried a prolonged quantitative tightening period through 2018. It ended in kind of the repo fiasco in 2019. That was kind of, I think, a wake-up call as to the ability of the Fed to normalize the balance sheet. If you would, I guess explain kind of what happened post the Fed's pivot on quantitative tightening back then, and if you think that's, we're approaching a similar event going forward.
So back in, so the Fed was the first central bank to ever engage in quantitative tightening, and they were doing it at a pretty conservative level. Back then, the maximum amount that they would, quote unquote, shrink their balance sheet, so quantitative tightening a month, was about $50 billion. In contrast, today, the maximum amount they're theoretically willing to do is $95 billion. So they were doing it very conservatively, and everything seemed to go well. Then in September 2019, there was some excitement in the repo markets, where repo rates spiked from, let's say, about 2% to as high as 9% intraday. Now, repo, for those of you who don't know, is a very sleepy but very important market. The repo market is basically where people borrow cash against U.S. Treasury securities, usually on an overnight basis. This market is about $1 trillion in size. Actually, it's probably closer to 1.5 trillion today. So it's a really large and important market. Usually repo rates, they don't really change too much on an intraday or day-to-day basis. Let's say a few basis points here and there. Now, in September, though, they suddenly rocketed from about like I mentioned, just about 2% to exploding higher. And that's really, really uncommon because such a large market is usually not supposed to have this kind of illiquidity, these huge price fluctuations. The Fed looked at that, and the lesson that it took from the repo spike in September 2019 was that there were not enough reserves in the system. That is to say that they had run quantitative tightening too aggressively, and the financial system did not have enough cash. Now, that was the lesson they took away from them. And because that was a lesson, they then turned around and began adding reserves into the system by buying treasury bills. So September, October, and from then on, they were expanding their balance sheet, trying to add more liquidity back into the financial system. So this time around, when they're doing quantitative tightening, they're trying to keep in mind that there is a certain minimum level of cash that the banking system needs in order to function. And if you drop below that level, you could have accidents like what happened with the repo market in 2019. So as they're shrinking their balance sheet now, they're trying to figure out just what is the lowest comfortable level of reserves in the financial system. And they don't know. So they try to figure out by, let's say, building models or just doing surveys of banks and asking them what they think. So going forward, that's going to be the constraint on how far the Fed could do quantitative tightening. The Fed has said very clearly that they don't actually like having a big balance sheet. They prefer to conduct monetary policy by toggling the overnight interest rate. They feel like they understand that better. Having a multi-trillion-dollar balance sheet, they don't really know how that works. So they want to get out of that game. At the moment, it looks like, so today, reserves are, about $3 trillion. Now, a commonly cited Fed estimate is to have, let's say, the amount of reserves the banking system needs about 8% of GDP. So that's like $2.3 trillion. So we are several $100 billion above what the Fed thinks of as lowest comfortable level of reserves. So I think quantitative tightening based on that can go several months further. But there's also another perspective as well. And this is a perspective offered by Governor Waller. Now, Governor Waller says that when he's thinking about liquidity in the banking system, he's not just looking at the level of reserves, he's also looking at how much money is in the reverse repo facility, which is kind of like this huge excess wad of cash in the financial system. That number is about $2 trillion right now. So it appears like there's a lot of excess cash in the financial system. And from Governor Waller's perspective, when he's thinking about quantitative tightening, he's not just looking at bank reserves, but he wants to add reverse repo balances to it as well. When you do that, you can actually end up with a QT end date in a couple years. So there's a lot of runway there. So that's kind of how the Fed is thinking about this at the moment. Right now, I think as we're recording, there's a lot of concern about, let's say, the TGA draining the bank reserves and so forth. But I think the longer trajectory is that there's a lot of runway for this to go.
Okay, I'm also curious though to understand, I guess, or to have your view on how did the basis trade play into that pivot on quantitative tightening into 2019. I guess if you wouldn't mind explaining what is the basis trade and how it affects a lot of these demand for repo and things.
Yeah. Yes. Yeah. You mentioned that earlier. Apologies, I forgot to discuss that. So one of the interesting things in 2019 was that the marginal buyer of Treasury securities was actually the hedge fund community. So I like to look at asset prices from a supply and demand perspective. And so who is the marginal buyer is really important in determining the price. Back then, the hedge fund community was buying cash treasuries to the tune of actually over $1 trillion. So they were really big buyers. They weren't buying because they were speculating on interest rates of cash treasuries themselves. They were buying as part of an arbitrage trade called the cash futures bases. And what that is that they're looking at Treasury futures and they're looking at cash Treasuries, and they're seeing that there's a disallocation between the price of the two assets. They're thinking that the price for cash future for their price for Treasury futures is too high relative to the price of cash Treasuries. So in order to arbitrage that difference, they go short Treasury futures and they buy cash Treasuries. And the way that they buy cash Treasuries is that they buy it by financing it with a loan from the repo market. So they were doing this trade in huge size, and that was what was driving demand for repo back in 2019. The demand for that trade grew so much so that they basically sucked up all the money available to lend in repo, and contributed to the huge spike in repo rates in 2019. So that trade became very popular in 2019, all the way into March of 2020. In March of 2020, there was huge disallocations, to put it mildly, in the financial markets. The Treasury, the cash futures bases, it's a pretty safe trade if you could hold it to conclusion, because if you can keep holding that trade, eventually the price between futures and cash Treasuries converges and you make money. However, before that happens, the bases can also widen significantly. And since you're doing this with tremendous amounts of leverage, if you don't have enough margin to hold the position, you could get wiped out, which is what happened to a lot of people in March of 2020. And so that trade basically went away. However, it's come back in size starting late last year. Starting late last year, it seems like the real money community became more bullish on treasuries, and they were expressing that view by buying a lot of treasury futures. As they purchased more treasury futures, the price of treasury futures widened relative to cash treasuries, creating a basis, and the hedge fund community stepped in again to close that. They've been doing that in tremendous size. And so again, you kind of have a return to 2019, where the hedge fund community, because they're doing this cash futures basis trade, is again long cash treasuries to probably over $1 trillion, and the marginal buyer of treasury securities once again. And it's also why you see repo volumes are at literally multi-year highs.
Yeah. Well, it just seems like, this is another example, I guess, of those price insensitive buyers, right? They're sensitive to the arbitrage, but they're not sensitive to the nominal yield or anything of bonds. They're just leveraging it. But it seems like, the last time the Fed tried, QT in 2018, it created this large leveraged basis trade in treasuries that ended up becoming a problem. And now they're trying quantitative tightening again. And we have this huge, this basis trade is a lot of time leveraged up 50 to 1. So you're right. If you can hold on to it to conclusion, you can make the spread. But it also does have, like any arbitrage, right? You have a potential for high percentage, potential for small profits, and a very low percentage for significant losses. I guess, what is it? Go ahead.
You're picking up pennies in front of the steamroller.
Right, exactly. Well, I guess to me, the most important point in all of this is that hedge funds, when the Fed steps away from the treasury market, hedge funds become this marginal buyer of treasuries in a very big and leveraged way. I guess to me that also creates potential for turbulence in the treasury market that Dudley and you were referring to.
So I actually think I think the treasury volatility would be a lot worse if you didn't have hedge funds buying, let's say, $1 trillion worth of cash treasuries, right? Then you would have to, So at the moment, I think it's playing a stabilizing role in the cash treasury market. But there is definitely the risk, as you rightly note, that let's say we have some kind of blow up, as we did in March 2020. Then what happens? Well, back then, once those guys get wiped out, they have to sell all the cash treasuries that they're holding, right? So if you suddenly have a few $100 billion of treasuries being sold on the market, that's really bad for the cash market's liquidity. So that there's that possibility as well, but that's a tail risk. I think so far it seems like the market is pretty stable. So I think if there is a risk going forward, it would be this, in my view. So if you are a hedge fund putting on a repo trade, you have to borrow repo from a dealer, securities dealer. Now, securities dealers are highly regulated entities, so there's a limit to how big their balance sheet can be. So that is to say, how much they can lend and how much they can borrow relative to the capital that they have. Now, let's say, just for the sake of argument, that this cash futures basis trade is great, and they are the marginal buyers of treasuries, and it just grows and grows and grows. You will eventually reach a point where a hedge fund wants to continue to put on the trade, but they can't get any repo financing because the dealers are maxed out. They don't have any more balance sheet intermediation capacity. Okay, if that's the case, then, well, who's going to be the next buyer of cash treasuries? And, I don't know, but I do know, though, that treasury issuance is very large and continuing. So I think that's the point where you can have to look for a next marginal buyer where you could have discontinuities in price.
Yeah, well, it would seem obvious to me that the Fed stepped in 2019 to make up the difference when there were problems in repo. That as you mentioned in that quote that I mentioned earlier, that it seems inevitable that the Fed is going to have to implement some type of yield curve control or something to just because the trajectory of Treasury issuance is to the point where that the market potentially won't be able to function without it. In that light, I guess if you believe that we're in a kind of a new era of higher inflation, inflation trends just driven by these kind of secular forces, what kind of problem does it pose that the Fed will not be able to normalize the balance sheet in a way that would potentially counteract those inflationary forces?
So that is I would say, though, that if we have significant inflationary forces, the Fed should actually be shrinking their balance sheet faster than they currently are. Because one way that you can get inflation under control, in theory, is to raise longer dated interest rates. So we've hiked the Fed funds rate to 5%, which is the Fed's primary tool, but the 10-year yield still below 4%. One way you can get the 10-year yield higher is if you just speed up quantitative tightening. So I think if there's a persistently high inflation in the country, it actually argues for a more aggressive quantitative tightening. That is a smaller Fed balance sheet. Until, of course, there's some degree of financial stability, then there's a really difficult question. And I think this is what you're getting at. So how do you shrink your balance sheet, but also maintain financial stability? I think that's when yield curve control could come in. I do think that just looking at the big problem from a bird's eye perspective, that does seem to be the inevitable way that monetary policy will be conducted, from my perspective. And we already see the Bank of Japan, which is kind of avant-garde. They're first to do big QE, one of the first to do negative interest rates, and now, and of course, yield curve control. And so maybe that's how the world will end up.
If you think we're headed down that path, and we have seen a sea change in these things, what do you think that means for investors? How do you think investors will have to adapt or change in the years ahead from the behavior that they've engaged in for the last 10 years?
I think the big change will be that bonds are no longer going to be, I think, the safe asset that has a negative correlation to equities. I think what happened last year when bonds and stocks were positively correlated is a glimpse of the broader trend going forward. So, I mean, just think about it this way. Let's say that you're buying a stock and the CEO goes out and tells you, "I'm glad you like my stock. I'm going to issue a ton more of that stock this year, and I'm going to issue more of that stock next year, and the more, what are you going to do, right? Does that make it a good buy?" And you're like, "Oh no, I got to get out of here." So that's exactly what the U.S. Treasury is doing. It just blows my mind to think that there are still people who are just, that 10-year yield is below 4%. So if you realize that, maybe this the trend for yields is higher, I think the logical step is you move your money into something like actually equities, because at the very least, if we have an inflationary world, the equities benefit from that through the revenue channel. So if you're a company and we are in inflationary times, maybe your top line will go up a bit more. If you look at countries that have very high inflation, I don't like to point at Argentina, but just as a caricature of what a world like that looks like, well, the Argentine stock market actually does really, really well in nominal terms. So I would think that a shift out of treasuries into real estate, into equities, into gold would be the logical step in that world.
Okay. Yeah, I was going to ask you your thoughts on real assets, but it just seems like in an environment of elevated inflation and persistent elevated inflation, real assets would seem like a natural way to go. Joseph, thank you so much for taking the time to do this. I highly recommend your work. Your website is fedguy.com, and your Twitter feed is terrific. I always kind of am eager to see your thoughts on what's going on with the Fed meeting or whatnot, and that's just at FedGuy12. Is there anywhere else you'd like to point people to? How can people follow your work?
Yeah, thanks so much for having me. Like you mentioned, fedguy.com is where I write about the markets. If you're interested in weekly macro updates, I also have a YouTube channel. It's just called Joseph Wang. So you can find me on YouTube as well.
Yeah, that's wonderful. I just actually watched your latest update right before we started recording, and I appreciated that the fact that you do those regular updates on kind of timely things that are going on in the market. So, Joseph, this was great. Thank you so much.
My pleasure. Talk to you later.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.